Hello. Good morning, everyone. I hope all of you are doing well. Good morning.
Good morning, students. Welcome back to the session 2, Accountancy by CA Adarsh Shanai. Adarsh Shanai is a chartered accountant in practice. He has authored books on indirect taxes, auditing and assurance for CA Intermediate and co-authored a book on accounting for CA Foundation. He has been teaching the subjects of accountancy, audit, and indirect taxes across different levels for CA and CA students in different locations across Karnataka. He has also conducted study workshop for students across the state. I, on behalf of Trisha classes, welcome you, sir. Now I request CA Adarsh Shanai to take over the session. Over to you, sir.
Thank you, ma'am. Hi, good morning, friends. Yes, hope all of you are doing well, and welcome to the crash course, the day one of the crash course, second session, first session of accounts. Yes. So before I begin, first I'll just set some ground, and then we will start with the syllabus. First, before I start, I'll tell you what to expect out of this crash course from the classroom and what to expect from yourself. What should you be doing beyond the classroom? So that is what I'm going to discuss. Now, although this is online, exams will be real, right? So I want you to be completely serious in the next few days left. Now we don't have a lot of time left. We have around 2 months, but the crash course for 30 days is going to be very effective if you guys participate in that actively and do what you're supposed to do properly. So if you do that, I'm certain that you can score great marks, no matter how much you've studied so far, even if you begin now. But provided you're very dedicated and committed to what is going to happen in the class and what homework is given beyond the class. So first, I will talk about the subject very briefly, and then we will move ahead. Okay. So from the exam point of view, as much as possible, we're going to stick to the exam point of view. and we are going to solve problems which will be important, which are important for exams. We'll also solve some past question papers. We'll also solve some RTP revision test paper problems and all that. So looking at all that, if we solve all the crash course problems that I'm going to give you, there are some homework problems also which will be given. There will be some additional classroom problems will be done. Most conceptual problems will be done. I will cover up all the concepts during the crash course, and also some homework problems you will have to do, which are not additional concepts, it is the same repetition. So all the chapters we will do thoroughly, but we will go a little faster. So because it's crash course. So some things which are not so important, or if it is not so difficult to understand, I might just fly through it. Otherwise, we will cover all the important topics. As per my understanding and experience, I've seen that students struggle in some part of some chapter. It's not always the whole chapter is not difficult for anyone. It's some part in one chapter, a couple of chapters here and there, we find it difficult. So my focus will be on such things, such topics, because at the end of the day, the hand holding is required relating to those topics. So we will discuss those topics in detail. But some easy topics which we can study, I will just brush through it. I'll just go through it. Proper revision. Other topics I might go into detail, which we find difficult to study on our own. I'll go into detail. So that is what is going to happen throughout the crash course. Okay, that is what we're going to discuss. We're going to do during the crash course. Now, first today's topics for discussion. And also remember, before every class, like let's say at the end of today's class, I'll tell you what to expect for tomorrow's class. What are we going to do in tomorrow's class? I'm going to tell you, I'm going to give you a prior notice of this. In the classroom, I'm going to declare what subject, what chapter I'm going to do tomorrow. So when I do this, it is not just for information I'm telling you. I'm telling you that because I want you to read that chapter briefly. I want you to look at that chapter and come to the class. Just open your textbook, just whatever classroom material or whatever textbook you have, just open it once and just refer it once before you come to the class. Okay, so today we will discuss some basic stuff. Today we'll discuss the first chapter, theoretical framework, and we'll also discuss the accounting process. Now, from the exam point of view, I'll also tell you every chapter what kind of questions to expect, what questions have come, because with the research and with the understanding I have the paper, I can give you some insights about each of these chapters which we're going to discuss in the classroom. So every day I'll give you some insight of the chapter we're doing. I'll also tell you what kind of questions have come, what questions can you expect, what are the hot favorite. I'll just tell you that much. Okay, of course I can't predict the paper, but I can tell you what are the favorites and what you can expect from the exams. I hope all of you are comfortable. I'm clearly audible, and I hope I'm visible to all of you. All right, say hi, hello once. Come to the chat box and say hi, hello. Make yourself feel comfortable, and also make me feel comfortable. Okay, wonderful. All of you are there. Yes. If you have any questions, you can ask me those questions in the chat box whenever you get that question. I might answer it at that point, or I might keep it for later. But if I don't answer it, ask me again at the end of the class. You can ask me again. Okay. So that is how we are going to go about. Now I'm going to put the screen. Yes. Okay. I think you've got this material. I hope you've got all of you've got it. If not, contact your coordinator, you will get this material. So this is what we're going to discuss. I think only a couple of chapters is being sent to you now. So we will discuss from this material itself. I've added some questions to this material, important ones. We will discuss. Conceptual problems also are there. Now, as we all know about the paper, in the exams, what can you expect? It is a 100 marks paper, completely descriptive. 100 marks also is accounts. There is no split in accounting, and it will contain 6 questions, out of which you have 6 questions of 20 marks each. Okay, 6 questions of 20 marks each. But out of those 6 questions, the first question is compulsory question, and out of the rest 5, you have to attempt 4. Okay, out of the rest 5, you have to attempt 4. And one of the questions, the third question generally, so far it's been the third question. Third question will have one additional 5-mark question in an option within the option. So there will be 25 marks worth third question, out of which you have to attempt only 20 marks. So recently they had asked a question from average student and account current as optional. You had to attempt any one of those. So that has been the paper pattern. And first question is a compulsory question. In that 12 marks will be true or false questions. Okay, true or false question with reasons. You have to give reasons also for your answer. So that is your first compulsory question, 2 marks each. Okay. So we have covered today we're going to cover 2 chapters through this material, and also I'm going to keep some foundation for the next chapter, that is rectification of error is the third chapter we're going to discuss in the class. So I am going to keep some foundation when I finish accounting process today. I'm going to keep some foundation for the next chapter also. I'm going to link something what we're going to discuss today. So today's lecture is very important with regards to rectification of error, which comes for around, I have put the marks allocations also for your reference in your material. You can find this also. This is what has been coming before. Okay, I mean, this is the history. This is how many marks we've got from each of these chapters. I've made a division and I've put it over here. You can refer it. So, sir, does this say that this will only repeat? No, but there's a pattern. As you can see, there's a pattern. Now, when I say C over here, C is a compulsory question. That is the first question is compulsory, right? So all the questions will be generally split. There is no 20-mark question generally asked, but there is a chance that they have asked a couple of times one single 20-mark question from sole proprietor. Finally, it comes sole proprietor. They have asked for 20 marks over here. You can see it. In the first attempt of CA Foundation, they had asked for 20 marks. Apart from that, they generally stick to 10-mark questions only. 10-mark, 5-mark questions, 15 marks ones asked from company accounts in the recent attempt. So this is how our paper pattern is going to look like. The theoretical framework will come for 4 marks compulsory question. 2C is basically a true or false question. Okay, 2C is 2 marks worth true or false question. So that can be split from any chapter they can ask. But generally, there's a pattern. One question from theoretical, true or false question from theoretical framework comes. Then you have accounting process, which has never been tested apart from the latest attempt, that is the November 2019 attempt. Before that, they had never tested a question from accounting process. You can expect one simple question even for your attempt because from November 19, there were some chapters which were deleted. They have deleted few chapters. So now they will ask a question probably from accounting process also. That is my understanding. That is what I think. Okay, so this is how the questions will be. So then how important is today's class? Because you told you're going to discuss 2 chapters today. We got also material for 2 chapters. That is theoretical framework and accounting process. But it doesn't seem so important for the exams, right? You look at the questions, number of questions which have been asked. It's just one is theory question, so we can study it on our own. Why do we need you for that? Or accounting process, we already know, what is there in that. But you know how strong our basics are, right? You know how strong our basics are, how we've studied journal, ledger, and all that. We know, we kind of have an idea. So what I'm going to do is, here I'm not going to focus too much on what concepts are embedded in these chapters. I'm not going to teach you what is there inside that chapter. I'm going to teach you what is inside that chapter, which is important to understand the future chapters. So I hope you're understanding this. So we are going to discuss those things which are conceptual, which are important for us to understand any of these chapters. See, if you don't if you don't understand the grammar, or if you don't understand the basic English requirements, although it could not be so useful, but when you go into the future, when you have to frame a sentence, you need to know basic English. You need to know the grammar. You need to know the tenses. So all that we're going to discuss in accounting from this particular chapter, that is the accounting process. Okay, now, so theoretical framework, what is this about? We will start now. We will start our discussion. Once before I start my discussion, as you can see, each and every chapter is important. Look at the November 19 November 19 marks allocation. This is index made by me itself. This is my index itself. This is theoretical framework accounting process, not exactly as per the institute's index, but it has resemblance. It is at the end of the day derived from the institute's index itself. Now, if you see over here, every chapter is important. Every chapter was asked at least for 2 marks. Bills of exchange being the least, they had asked for 2 marks. One true or false question was asked. C means compulsory question, as I mentioned earlier. C is compulsory question. So true or false question was asked from bills of exchange. So each and every chapter is important, but you can be strategic. You can have a nice plan. I will share the plan also with you as we go ahead. You can have a nice plan. You can group well and you can study. Okay, all these chapters you can group well as per the importance given to those chapters, plus our knowledge levels also. So based on that, you can group it and you can study and you can have priorities also. I'll share all that plan when we go further. So if you have a solid plan, I believe you can score 90 plus in accounting. And if you pay attention and if you are at your toes all the time, I'm sure 75, 80 is easy marks from in the accounts paper. Okay, so let's begin. Let's not waste too much time now. Let's begin. So first, we're going to discuss theoretical framework. Now, what is this chapter about? Theoretical framework is about introduction to accounting. Here we will discuss few topics, few things uh, when we discuss about the chapter 1. So, meaning and scope of accounting, accounting principles, concepts and conventions, capital and revenue expenditure. A true or false question is definitive. You saw that 2C in front of chapter 1 all the time. The true or false question is coming from capital expenditure and revenue expenditure. 4 attempts also, that true or false question was from capital expenditure and revenue expenditure. 4 attempts also. So that means the 5th attempt, your attempt also, it will be from that chapter itself, from that unit itself, that is capital expenditure and revenue expenditure. I'm putting it out. One prediction for you, one definitive question, 2 marks definitely for you is coming from capital expenditure and revenue expenditure. So if you study, sir, only 2 marks, 2 marks can be make or break. As we all know, you can get 198, and the difference between 198 and 200 is 2 marks. So I am telling you that 2 marks is coming from capital expenditure and revenue expenditure. You can trust me completely on this. Okay. And apart from this, 4-mark question is a theory question, which is being asked again from this chapter itself. So I have shared 20 questions with you. Okay, I have shared 20 questions with you. 19 questions are theory questions. The 20th one is the capital expenditure and revenue expenditure. Out of the 19 questions that I have shared, you will expect one question will come out of this 19 question itself. This is again something that I can tell you with great level of certainty. Okay, great level of certainty. I can tell you that one of the questions will be from this itself. I've been giving this material since last 2 or 3 attempts now. So one question will definitively come from this, and it has been coming. So one question will come out of this. I've covered almost everything from the first few units. So if you study this material, and when should you study this? Should you read it today itself? The answer is you can just go through it once, but the most important time to study this is just before your exams. Okay, just before your exams, that is a week to your exams, you can start taking up this material and you can start reading it. So there are around 19 questions. Each and every question you just have to go through it. And plus, if you don't have the material, please talk to your coordinator or talk to your concerned person. I'm sure they will guide you through. Now, out of this 19 questions, study and go. So 6 marks from this chapter is easy. You can score 6 marks out of this chapter easily. Now you have to just focus on these theory questions at the end. Not now. At the end, you have to study it. So please talk to your coordinator. The ones who've not got the material, I'm getting some messages saying that we've not got the material. I think the coordinator should help you with this. So they will guide you with the material. Okay, so please have the material and you can refer for all the questions from this material itself. Okay, now we will discuss some basics from this. 6 marks, definitive. This is on you. You have to read the questions and go to the exams. That's all. Okay, let's start. Let's start then. First, meaning and scope of accounting. Now, what is accounting? What do you mean by accounting? Is the first point, right? What is accounting? Accounting is a language of business, as I always say it. It's a language of business. That's it. It's nothing more complex than that. It's a way you communicate with the business. It's a way you know the business better. So we all, let's say you start a business, you start a venture, you put some money somewhere. Okay, let's not talk about business. Let's talk about you give a loan to a friend. Let's talk about simple things first. You give loan to one of your friends. You give some money to your friends. Now, when you give some money to your friends, friend, one of your friend, you gave, let's say, 2 lakh rupees. You're chartered accountant, you have a lot of money with you. So you gave 2 lakh rupees to one of your friends. Now, when you give this money to your friend, you will want to know what is happening to that money. You will want to know, what he's done with that money. You will want to know how much he's going to return it back to you. When is he going to return it back to you? And how much interest is he going to pay with that money that is taken from you? So you will just call him up, or you'll just talk to him, and you'll ask him, when is he returning the money, and what is the interest rate? You'll fix it with him, right? You'll sit and discuss it with him. So this is when you've given the money to one of your friends. Now, what if you have invested that money in a business? That money, 2 lakh rupees, let's say you have invested it in one of the business. You started a small shop. You want to know what's happening with that money. You want to know where did that money go? How much money you've earned because of that money. You want to know that because money can earn you money. So to know this, what we will do is we can't go and speak to a business, right? You can't ask a business. You can't dial up a business and ask what's happening with your money. So what we do is we are in need of information. This information is known as financial information. Financial information. So this financial information is derived or understood by us through something called as financial statements. Now, this financial statements is the end product or is the result of accounting. So we need accounting to derive this financial statement, which is financial information. Now, through the financial statements, we get to know two things. We get to know two things. One is the financial performance of the business, and the second one is the financial position of the business. So these are the two things that we need to know about any business entity, about any organization that is into business. So financial performance and financial position. So for this purpose itself, we drop the financial statements. This is why we drop the financial statements. Now, accounting is because we want to draw the financial statement. This is the information that it provides to the users. So that is why we call accounting as a language of business. Accounting is a language of business. Now, this is about financial statements. Can you tell me, can you just think, I'm sure you all of you know this, what is financial performance? How do we know the financial performance? How do we understand the financial performance? We understand it through an account called as profit and loss account. Very good. Profit and loss account. So what about financial position? How do we know the financial position of a business? That is through the balance sheet. Wonderful. That is through the balance sheet. Then we have some additional disclosures also that we make. In addition to these two things, there are some additional disclosures also we make as per the modern accounting, because we need accounting standards have come in, companies law has come in, companies act has come in, and all these laws and all tell us to make some additional statements, additional disclosures also. So that is also made. That is the third requirement, which is disclosures, additional disclosures. You have already studied about cash flow statement when you were in 12th standard, second PUC. You studied something called as cash flow statements. So cash flow statement is required by accounting standard 3. AS3 requires you to make the that disclosure. So like these additional disclosures are made later on because it is not the core part of financial statements. The core part of financial statement is these two things: financial performance and financial position. For this, we draw up balance sheet and the profit and loss account. So if you see any financial statement we're talking about, we have these two statements. Okay, two statements deriving financial performance and position. That is, be it an NPO. In the case of NPO, we don't call it as profit and loss account. We call it as what? Income and expenditure account. Income and expenditure account. Financial position, again, we draw up the balance sheet. So any kind of organization that is, the users will want to know the financial performance. So for that, we draw some account. We draw some statement. So this is how the financial information is given to the users. So now, next question, sir. Who are the users? Who are the users of these financial statements? There could be internal users and external users, as we have. We already know who are these internal users: the management, the employees, the owners of the company. So all these are internal users of the financial statements. There could be external, other parties, outside parties. Who are the outside parties? The investors, the potential investors, creditors, government. Why would government need the financial information? Government is big. Why does the government need your financial information? For calculating taxes on your income. Very good. For calculating taxes on your income, the government will also look at the financial statements. Not just that, a banker will also look at your financial statements. Why will a banker look? Because the banker will want to know your credibility, your capacity. Very good. Your credibility, how credible you are. Do you have the capacity to repay the loan? So for this, they look at the financial statements. Now, apart from this, you can have creditors. Big creditors also sometimes need your financial statements and all that. So these are the users. These are the users of financial statements. I hope all of you are comfortable with this. Then, sir, what else? What else should we discuss, sir, about financial statements? And I'll stick to financial statements. See this? I'll just go through the questions once. Okay, first the accounting process. We'll quickly finish these questions and then we'll go back to that. Accounting process. What is the accounting process? Could you please tell me the accounting process? First, it starts with recording. Where do we record it? Where do we record? At the end, we have to reach financial statements. Okay. As I mentioned, this is our important part in accounting. Financial statements are the end result. So let's reach this point by going through one by one. First, we record it somewhere. It's a process. It's a system. Can I draw the financial statements right away? Can I draw a profit and loss account right away? The answer is no. You got to have system. You got to have a control. You can't say during the period, if I want to know the financial performance, now directly I can't calculate profits or losses sitting here. I can't say, okay, this year this much expense, this much expense. You will not get control like that. This is the asset I have. This is the liability I have. You will not get control like that. You can't directly list out things. But we want financial statements at any cost. So for this, what we have to do is we have to draw up something called as we need to have a system. We need to have a system. So the system, the process, that process is known as accounting process. So it starts from recording. Where do we record? Where do we record? We record it in the journal or subsidiary books. We record it in the journal or subsidiary books. That is known as original books of entry. Those books are known as original books of entry. Once that recording is done, it is taken. This is a process. This is a system. This is just like how in a manufacturing entity. Let us say you want to manufacture something. You want to manufacture these remotes. Now, to manufacture these remotes, can you directly put everything together, screw it up, and give? No. You need to manufacture first. Probably the buttons. You have to manufacture the display. You have to manufacture different chips that go inside this, the different sensors that go inside this. maybe it's infrared sensor or different screws that go inside this. So you have to manufacture all that. It is a process. It's a long process. It's not direct. It's not directly obtained. So same in the case of accounting also, financial statements are not directly obtained. We need some stages, we need some processes. So first we recorded it somewhere, then what did we do? We classify it. Where do we classify it to? We classify it to, this is journal or subsidiary books. Classification happens into which books? Ledgers. The classification happens into ledgers. Then after classification, the third part, what is the third part? Summarizing. We make something called as a summary. Now, these three are known as bookkeeping. What is this known as? Bookkeeping. Now, in bookkeeping, the final stage is summary. It is the final stage is preparing a summary. That summary is known as trial balance. So we call this summary as trial balance. Now, through this, now we are almost ready. Okay, bookkeeping is done. Now we go into making the financial statements. So to make the financial statements, we need to have three steps. Three steps to make the financial statements. Which is the first one under this, the continuation of this process. We analyze. We take the trial balance. We analyze each and every account, the nature of the account. Which statement should it go to? Is it useful to find out the financial performance, or is it useful to find out the financial position of the business? We have to sit and analyze. That is the fourth step in accounting process. And then once we put it together, we sit and interpret the financial position and the performance of the business, which is communicated to the users. So this is what happens in accounting. All these three steps are financial statements, relating to financial statements. So finally, we have the financial statements with us, which are given to the users. So the whole process is known as accounting. In that, the first three steps is known as bookkeeping. So this is how our procedures or process of accounting works. So I have given the material. You can just read it from here. The different steps we have discussed it: recording, classifying, summarizing, and analyzing, and then interpreting and communicating. Then bookkeeping and accounting. Accounting is a broader in a broader thing. Bookkeeping is a specific thing. You can read the differences once. In bookkeeping, there is no financial, we don't drop the financial statements. The financial position and performance is not determinable at bookkeeping stage. Looking at the trial balance, you can't get to know what is the profit or what is the loss of the entity, or where does the entity stand. You can't know that by looking at just the bookkeeping records. Looking at the trial balance, you need to drop the financial statements, which is part of accounting. In cash and mercantile system of accounting, cash system is something, this is not so important for exams also, but it was there in one of the revision test papers, so I've added this question. So in this system is not followed by us, but cash system is where we record all the entries only when cash is paid. Cash is paid or cash is received, we record the entries. That is known as cash system. So as you can see, cash system of accounting is a system by which a transaction is recognized only if cash is received or paid. So this is a system wherein we don't record, it's not accrual basis. What we do is accrual basis. When we earn income or when we incur an expense, we record it. That is known as accrual system or mercantile system. It is also known as mercantile system. So that is a system which we follow generally. This is what is to be followed by us in accounting. But transactions into assets, liabilities, equities, cost, revenue, and recording thereof. A transaction is recognized when either a liability is created, impaired, and an asset is created or impaired. So whenever there's a reduction in liability or a reduction in an asset, or increase in asset or increase in liability, we record those entries in the books. A record is made on the basis of amounts having become due for payment or a receipt, irrespective of the fact whether payment is made or received actually. So that is mercantile system. That is accrual system of accounting. That's what we do. And cash system is when we record the entries only when the payment is actually made or payment is actually received. That is cash system of accounting. Okay, you can just have a look at this question later on. Not so important according to me for the exams, but have a look once. Explain the objectives of accounting information, the financial systems. Okay, this was to be covered by us. Here, what do we do with the financial statements? What are the objectives? One, we have to record the transactions. This has come for 4 marks. I think this question has come for 4 marks in some mock test paper or something, if I'm not wrong. So not your actual question paper, it's come in the mock test papers. One of the mock test papers before it has come. So could be important for exams also. Systematic recording of transaction. We have to record the transactions. Ascertain the financial performance of the business. That is, what is the business car results? We have to ascertain that. Financial position, which is the standing of the business, and communicating the information to the users for rational decision making. Okay, what are the objectives or what are the characteristics of financial statements? Qualitative characteristics they have asked. So this is again a question which had appeared in one of the mock papers. So understandability, reliability, relevance, comparability, materiality. I would advise, don't get into depth of all these things. It's not so important. Just read, study it just before the exam and go to the exams. Okay, limitations, which I feel is very important for your exams. Limitations which can be which must be kept in mind while evaluating the financial statements. So basically, what are the limitations of accounting? That's what they're talking about. It does not record qualitative aspects. It does not record qualitative aspects. Now, as you can see, around you, there's a lot of businesses are suffering a lot. Businesses are going through a lot of things because of the virus, because of the coronavirus, because of the lockdown. Many things are happening. But when you look at a business assets or liabilities, you will not know this. Or when you're looking at the financial statements, you will not know this. That is not mentioned in the books financial statements. We don't record qualitative aspects. We don't pass a journal entry for all this. But does it make an impact on the business? The answer is yes. It does make an impact on the business, but we don't record it. That is one of the important limitation. So it cannot be measured in terms of money. So if it's not measured in terms of money, we don't record it. Or we don't record. Also, how do we know a business? How do we evaluate a business? We evaluate a business on past information, which we believe that the financial position, or we look at the financial performance of the business from the past data and we judge the business. We say this business is good or bad looking at just the past data, which could be real or which could be false for the future, right? You can't take a decision exactly like that. Now see, you have scored 95% in 12th standard. Just by scoring 95% in 12th standard, does it mean that you're going to be rich or you're going to make a big future tomorrow? Or a person who scored 45%, does it mean that he's failed in his life? Can you judge a person like that? Can you see that he's never going to be successful in his life? No. No, not really, right? He can make a comeback. He can work hard. He can study. He can score good marks tomorrow. He might become successful. So you cannot judge a person based on his past. As simple as that. You can't judge a business based on his past. You can't judge a business based on its past. You can't look at it and say, okay, last year we made this much gross profit, so that means we're going to make more profits in the next year. You can't do that. But what do we do when we look at the financial statements? We exactly do that. We judge a business based on the past data. Financial statements give you only the past data. So it's a limitation. Also, it ignores changes in some money factors like inflation. That is, time value of money is ignored over here. And I was coming across one wonderful quote on inflation. What is inflation? Inflation is ignored in accounting. They say you are economics students, so you know what is inflation. But I came across a very nice quote the other day when I was reading some book. In a very nice term to actually explain what is inflation. There was a person His name was Henny Ingsman. So he gave this quote. Henny Ingsman gave this quote. This was US. I'll Indianize it to you. I will make it Indian to you. Let's say 500 rupees for 50 years back. Okay, inflation has made people stronger. Inflation has made people stronger. How? 500 rupees worth groceries 50 years back. 500 worth groceries 50 years back must needed at least three people to carry it, three or four people to carry 500 rupees worth groceries 50 years back. Today, 500 worth groceries, a small 5-year child also can carry. Okay, that is inflation. That is inflation for you. So it's become people have gotten stronger, right? People have gotten stronger in 50 years. A very nice quote. That is the fall in value of money. That's because of inflation. For 500 rupees, you get way lesser goods now when you compare it to 50 years back. So that is how the value of money has fallen down over time, which is ignored by accounting. Accounting will now record Marudala. In the classic financial accounting, we don't record this. There are occasions when accounting principles also conflict with each other. So there are conflicts within the accounting principles, some of which I will discuss with you in the later stage. There are some accounting estimates also which are used over here. Different accounting policies for the treatment of same item adds to the probability of manipulations. Like for example, the same item can be measured in different things. For example, depreciation. Depreciation, we have multiple methods for depreciation, right? The same amount, the reduction in value of an asset is known as depreciation. But depreciation amount can be different based on what policy you adopt, what method you adopt. So that amount can be different. Inventory valuation, closing stock valuation. Closing stock is an event. Now, the valuation of that event could be in different terms depending on what policy, what accounting policy you are adopting. So that is why the same item can have different valuations because of different accounting policies we have. Okay, then accounting concepts, the different accounting concepts, you just go through it once. One is the separate entity concept. I'll quickly run through these concepts. We already know most of it. So what is separate entity concept? Separate entity concept is the concept wherein uh, we make a division between the owner and the business. So the owner is not the same and the business is not the same. So what is its impact on accounts? Can someone tell me what is the impact of the statement on accounts? The impact is visible in the financial statements, the balance sheet. In the balance sheet, when you make what impact what impact do you see over there? Capital. Very good, Aaron. Capital is prepared separately. We show capital as a liability. Capital is treated as a liability, and we show it in the balance sheet as a separate, along with bank loan, along with other things, we show it over there. So that is because of this particular concept, the separate entity concept. Money of money. So when I say money measurement concept, we are talking about we record only those things or those transactions, those events or those activities which are measurable in terms of money. Going concern concept. What is going concern concept? Going concern concept says that the business will prevail or the business will run or the business will go on for not forever. It doesn't say forever, it says for a long period of time or for a foreseeable future. For foreseeable future, the business will go ahead. That is what going concern concept says. Now, what is the impact of this going concern concept on our accounting? Because of going concern concept, you have something called as fixed assets. Because of going concern concept, you have something called as non-current liabilities. So this is all, you drop the balance sheet because of this going concern concept. Otherwise, every other expenditure or every income, every revenue would have been a revenue item. It would have been a current item, temporary item. The concept of fixed assets, the concept of non-current items comes because of the going concern concept. Then you have periodicity concept. What is periodicity concept? The periodicity concept says that split the economic life of the business into smaller periods, which is known as periodicity concept. So here we split the the economic life of the business into accounting periods. Now when I say accounting periods, it could be accounting year, or it could be accounting months, quarters also. Okay, so when I say period, we're not just referring to an accounting year, it could be smaller accounting periods also, but that is as per this particular concept. Then the most important concept that we have to remember is the cost concept. Now what do you mean by cost concept? Cost concept says record all the assets at the cost incurred to get that asset, to acquire that asset. So historical cost, very good. Historical cost relating to the asset. Now, what do you mean by all the costs, sir? The purchase price of the asset plus all other expenses that you have incurred to acquire that asset. For example, can you give me some examples for expenses that you may incur? Transportation, very good. Installation charges, very good. What else? Overhauling expenses in the case of second-hand assets, very good. Transportation charges is freight. Wages, installation related wages, repairing, whitewashing at the point of purchase. If you're doing all this, alteration, anything you're doing at the point of purchase to buy, to get that asset ready to use, to that stage that like whatever cost you incur, that is to be called as the value of the asset. That is as per the cost concept. It could be carriage, cartage, renovation of an asset when you're buying it. Insurance at the point of purchase, insurance is generally recurring in nature, but at the point of purchase, whatever expense you incurred, that is to be called as cost of that asset. Okay. Then we have a realization concept, or this is known as revenue recognition concept also. What is this realization or revenue recognition concept? It's basically saying we discussed this convention called conservatism. So in conservatism also they say the same thing, that be conservative. When you recognize the revenue, ensure that there is 100% guarantee of recovering that revenue. When I say revenue, what are you referring to? Revenue share. What is revenue? Revenue means what? Income. So when you're recording that income, ensure that there is guarantee that you're receiving that income. You're going to receive that income in the future. If not now, you're going to receive it tomorrow. But there must be some certainty, there must be some guarantee with regards to receiving that income in the future. So that is what this particular concept is saying, which is realization or revenue recognition concept. So the income, whatever you record, must be realized at some point of time. Some point of time you must realize it. There must be that level of guarantee or that level of certainty. Then you have dual aspect concept. This is again core for accounting. Dual aspect concept. What is this dual aspect concept saying? Every transaction that we record in the books has two effects. How many effects? Two effects. So we're not talking about the accounts involved. We are talking about the effects given in the books. Two effects will be given for each and every transaction recorded in the books. What are the two effects? It is debit, we call it as debit, and credit effect. Now these will be equal equal effects. So debit is always equal to credit, and because of this very concept, our balance sheet tallies. Okay, our balance sheet tallies at the end because of this particular concept. That is why the balance sheet totals will tally. We get a equation because of this concept. What is the equation we get because of this concept? The balance sheet equation, what we call as balance sheet equation. What is the balance sheet equation? Assets is equal to liabilities plus capital. Capital is also known as equity. When we talk about companies, generally we use the term equity. So this is the formula, this is the equation we get because of this dual aspect concept, because you record debit and credit everywhere. So that is how we derive this particular equation. Then you have something called as the accrual concept. What is accrual concept? Accrual concept, as I mentioned, this is where I discuss, about mercantile system of accounting. We follow this accrual concept seriously. Accrual concept means record all the expenses and income whenever they are occurring. Whenever they are occurring. Don't wait for the money to be exchanged. Don't wait for the payment to be exchanged. If you wait for the payment to be exchanged to record it, that will not become accrual concept. What will that be called? That will be cost concept, or rather cash concept, cash basis. So that is a different accounting method. We don't account like that now. We account how? We account as per the accrual system or the mercantile system. Mercantile system or accrual system, it's the same. So as per this system, we record. So under this system, it says, please record every transaction as and when they occur. Don't wait for the payment to be exchanged. Then you have the matching concept. Matching concept says that we have to match all the expenses. We have to match all the expenses and income as and when we in that period itself. It must be relating to the same period. A period's expenses and incomes must be matched. Bhavna asks, sir, what is the difference between realization and accrual concept? Revenue recognition concept is more about conservatism, and it is relating to the sales. It is relating to incomes, more specific to income. When I say accrual concept, it is about the overall accounting approach. You can say there is some similarity between realization, revenue recognition concept, and accrual concept, but accrual concept is much broader, and it is relating to the whole of accounts. Now coming back to matching concept, because of matching concept, we get one equation, the profit and loss equation. What is that equation? We get one equation which is nothing but profit or loss is equal to incomes minus expenses. So all the incomes during a particular period must be matched against the expenses of that period to find out the profit or loss. So if this answer is a negative, if expense is more than the income, then the answer will be negative. If the answer is a negative, then we call it as loss. So that is about the matching concept. Then we have 4 conventions: conservatism, consistency, materiality, full disclosure. I'm going a little fast over here because it's not so important for the exams, and the concepts will be discussed later on also. So I'm just running through this notes. I hope you are all comfortable with this pace. Only for this one chapter, I'll go a little fast. Okay. Convention of conservatism, consistency, materiality, and full disclosure. Now, first, conservatism. What is conservatism? Conservatism is, yes, it is the very good. It is a policy of safety, you can call it. Prudence, correct. So, what do you mean by prudence? Whatever anticipated losses you have, please write it. Please record all the anticipated losses, but never record the anticipated gains. So whatever expected gains you have, don't record it, but please record all the expected losses. So that is what conservatism says. And then you have consistency. What is consistency? Consistency is nothing but uniformity, following the same thing again and again. So the convention of consistency is used in the case of accounting policies, the methods. There are various methods, as I was telling you earlier also. There are various methods for certain aspects. For example, in the case of depreciation, you have certain methods. In the case of inventory valuation, we have some methods. So for all these methods now, you have to choose one method itself, and you have to follow that method year on year, accounting period after accounting period. The same method is to be followed consistently. So this is known as convention of consistency. So does that mean that I cannot change the method at all? No, sir, you can change the method. We have 3 circumstances where we can change the method: be it depreciation method, be it goodwill valuation method, be it inventory valuation method. anything, investments also, there is valuation methods for investments also. Whatever method you're talking about, you can change it in 3 circumstances. I'll talk about it very soon. So, but consistency says that unless and until those 3 methods arise, you cannot change the policies, accounting policies. Convention of materiality. This is a convention which is not, I can't tell you, here only where this materiality is used and all that. Different places we use this convention. Different places we use something called as materiality. Be it while determining capital expenditure or revenue expenditure. That is, if we should book an expense as an asset or should we show it as an expense in the profit and loss account. So that will depend on materiality, material. So this is a convention which is used in many places. The convention of materiality. And finally, we have convention of full disclosure. So whatever transactions you're making during a particular period, that is, whatever transactions a business is being affected with, you have to disclose it. Somewhere disclose it. It could be in the profit and loss statement, or it could be in the balance sheet. You have to disclose it. That is full disclosure. You have to write it in the financial statements. All right, so that was about the conventions and the concepts. I just went through this. You can read it on your own, I feel. If you have any questions, you can ask me, of course. Question 9, discuss the fundamental accounting assumptions. 3 of those convention or concept, we have called it as fundamental accounting assumption, which is going concern concept, consistency, and accrual. Now, accrual concept is a fundamental accounting assumption. That is why we follow the accrual method of accounting, not the cash method of accounting. Accrual concept is one of the fundamental accounting assumption. Okay, then contingent asset and contingent liability. Contingent asset and contingent. Here they have asked a question. Differentiate between liabilities and contingent liabilities. Now this question has come 2 times. May 18 and November 19. This question was asked 2 times in the exams. Differentiate between liabilities and contingent liabilities. So could be important for your exam also, but because it's come for the latest attempt, I don't think you can expect this question for your attempt again. But this has been examiner's favorite from this particular chapter. Now, what is this contingent assets and contingent liability? I'll quickly discuss this and then we will move ahead to the next concept. So contingent asset and contingent liability, what do you mean by first contingency? We will understand the term contingency first. Contingency means uncertainty. Okay, contingency means what? Uncertainty. It may occur, it may not occur. It may happen, it may not happen. So that is contingency. For example, vaccine for coronavirus. We are all waiting, right, eagerly. Someone said Russia has a vaccine, but I don't know how effective it is. That's what people are saying. So it's a contingent event. Finding out a vaccine is a contingent event. So that is contingent, uncertain. We don't know if it's going to happen or not. Rain. It may rain, it may not rain. So you don't know, with certainty if it's going to happen or not. That is known as contingent. Now, in the case of businesses also, a business will have some contingent assets and contingent liabilities. Contingent assets are that position or that situation where we might have to receive money if that event happens. It's linked to an event, okay? If that event happens, I will receive money. So that is contingent asset. For example, a case filed by a company, a legal case filed by a company against a third party, against some other person. I generally give this example between 2 big companies, the tech companies, Samsung and Apple. How there was a suit filed by Apple against Samsung in early 2011 or something, 2011-12. It was a patent infringement suit, a claim. Or for example, very recently I had heard this about Shah Rukh Khan's movie again. There was a movie called Fan, right? You've watched this movie called Fan. Not such a good movie, I hear. I haven't watched it. But in that movie, there was a song, it seems. There was supposed to be a song, which was Jabra Fan. There was a song called Jabra Fan. So this song was played all over during the trailer of the movie. When the movie was being promoted, they were playing this song. Shah Rukh Khan was dancing to this song in different events and all that as promotion for the movie. They were promoting this. Now, a person went to watch this movie, fan movie he went to watch, and he did not find that song in that movie. Okay, you know what he did? He filed a case against the producers of the movie. He said that he was cheated. He was cheated because they were showing that song during the promotions of the movie. They were showing it in the trailers of the movie, but they did not show that song in the movie. They did not have the song was not part of the movie. So he filed a case against the producers of this movie, and actually he won the case also. He won the case, and the producers had to pay some 10,000 rupees to that guy as damages. He went to the consumer court and he won this case. Now, if you look at the producer's balance sheet, he would have to show this as a contingent liability. And when you look at that the person who we were talking about, the person who filed the case against the producer, for him it is a contingent asset. Because on a future date, before the case is decided, I'm telling you, before the case is decided, there is a chance for that person. We're talking about the person. Let's say I am that person. I've filed a case against the producer. Now, I have a chance of getting some money. So this is a contingent asset for me. On a future date, if the judge decides in my favor, I have a chance of getting some money. This is known as contingent asset, uncertain asset. It might happen, it might not happen. I might win the case, I might not win the case. But if I win the case, I'm going to get some money. If I lose the case, am I going to lose some money? The answer is no. If I lose the case, so I'm not going to lose anything, right? If I win the case, I'm going to get money. So that is why for me, it is known as an asset. That case in the court is known as an asset. For the company, for the producer, look at his perspective. What happens if he wins the case? Is he going to earn some money if he wins the case? What do you think? Is he going to earn some money if he wins the case? The answer is no. He's not going to get anything if he wins the case. But is he going to lose some money if he loses the case? The answer is yes. So there is no anticipated gain at all here. There is only anticipated loss. If it happens, then there's a loss for me. So that is why we call this as a contingent liability. What do we call this as? Contingent liability for the producer. Now, is this a transaction when a case is filed in the court of law? Do you think it is a transaction? Is it a transaction? No. It's not an activity involving money. It's not a transaction. Remember this. Rather, it is something that might happen. It's not even an event at this point of time. It's linked to some event in the future. It's not even an event at this point of time. It might happen, it might not happen. There's uncertainty. It's an uncertain event in the future. Can we record these things in the books? Can I record it? Should I record it in the books? No, we record only transactions. We record only events which have happened already. This is something that has not happened at all. So should we record it at this point when the case is filed? The answer is no. Then what do we do with this? We have to disclose it. We have to disclose it. That to disclose what? Should we disclose both contingent assets and contingent liability? The answer is no. Do not disclose contingent assets. AS 29, Accounting Standard 29 says, do not disclose contingent assets. Only contingent liability is to be disclosed. Accounting Standard 29 says this. So what we disclose is contingent liability is only. So contingent liability is to be disclosed in the books of in the balance sheet as a footnote. It should be given as a footnote. But liability is to be shown. Liability is to be shown in the balance sheet. Sir, is this anticipated loss? Is it exactly anticipated loss? No, it is not. It might happen, it might not happen. There is uncertainty. We should we should record only losses, not gains. Conservatism says recognize losses, future losses, not gains. Okay, so that is about the provision and liability. Now, if I have to discuss some differences between contingent liabilities and liability, could you tell me some differences? Liability is certain, is it? Liability is certain. Very good. You have to pay this. This is uncertain. Contingent liability is uncertain. What other point do we have? Liability can be measured with accuracy. For example, you take a bank loan. You take a bank loan. Do you know how much to repay? Do you know how much to repay? Yes. You can measure this. But contingent liability, do you know with accuracy how much money to be we might have to pay tomorrow? No, it will depend on the event. It will depend on what is going to happen tomorrow. So it is not measurable accurately. I mentioned, that Jabra thing. Can the producer say how much I have to pay money with certainty? The answer is no. He can't say with certainty. So that is why not measurable accurately. Then with regards to disclosure, where do we show liabilities? Where is liability shown? It is part of the balance sheet. It is part of the balance sheet. Liability side, we write this. This is disclosure. We write it in the balance sheet. What about contingent liability? Is it part of the balance sheet? The answer is no. It is given as a footnote to the balance sheet. It is given as a footnote to the balance sheet. I hope you're following this. This is about liabilities and contingent liabilities. And liability is something that has happened already. You've already incurred it. Contingent liability is yet to be incurred. As I mentioned, the first point itself covers it. So remember these 3 points, important for your exams. Then apart from this, there's something called as provision, difference between provision and contingent liability. One more question. What is provision? What do you mean by provision? Very good. Amount set aside for an anticipated loss. Now here, there's already an anticipation that this loss is going to happen. For example, provision for bad debts. Yes, provision for bad debts, or what we call as provision for doubtful debts. Now this is a provision which is certainly going to happen in the past. Also, this has kept happening to us. There will be some debtors who will not pay us the money. Some 2% or 3% of the total debtors don't pay us the money. So that keeps happening. It has happened in the past also. It will happen in the future also. So again, this is a certain anticipated loss. It's an anticipated loss. But this is not an anticipated loss. It may happen. The loss might happen. It might not happen. But here there is certainty that it's going to happen. This is certain. This anticipated loss is certain. With regards to contingent liability, it might happen, might not happen, but provision is going to happen. Can we measure this accurately? Can provision be measured accurately? No, but it can be estimated. It can be estimated with some level of accuracy. Not exact, but some level of accuracy. If I say 3% would be total bad debts this time, 3% of the total debtors will be bad debts. It need not be exact 3%, but it could be hovering around somewhere around 2, 3.5, 4. Some accuracy will be there. If not perfection, it won't be precise. It won't be exact, but it will be somewhere around that estimate. So that's why we call it as an estimate. But contingent liability, not measurable at all. You can't measure it at all. Now, probably that fan guy might have put a case against the producer for crores of rupees. He might have claimed 5 crore rupees as damages. He might claim 100 crore as damages. He might put some random number and he could claim it. Does that mean that it is going? We have to pay that much money, 100 crore rupees to him? No. For example, you have these defamation cases. I'm sure you read this in the news. Politicians put random defamation cases against other people for hundred thousands of crores. Now, does it mean that you will get that 1,000 rupees, 1,000 crore rupees as defamation? The answer is no. So that is why it is not measurable easily. It's not measurable. What about provision? What about provision? Disclosures relating to the provision. This is recognized. It is shown in the balance sheet again. It is recognized in the books because this is anticipated loss. It's going to happen. We know it's going to happen. And prudence, conservatism says, what does conservatism say? Book all anticipated losses. So we recognize the provision. We recognize the provision. However, we don't recognize the contingent liability. So this is given as a footnote. This is shown in the balance sheet. This is footnote to the balance sheet. So this is about the provisions and contingent liability. Again, I don't know how much chances there of this question coming to at exams because it was asked in the recent attempt. It was asked in the recent attempt. So that is why I'm not very certain about this question. So disclosures. Okay, mark this as important. Disclosure of contingent assets and liabilities. So where do we disclose contingent assets? Contingent assets is not disclosed in the financial statements, but you can write it in the board's report. Okay, it might be recognized by the board of directors in their report. You might mention it, but not in the financial statements, not in the balance sheet, not in the footnote to the balance sheet. Contingent assets must not be disclosed anywhere as part of the core financial statement. But in an annual report, there will be something called as board's report. Now, when I'm talking about annual report, it's not going to be just one page of I'll show you annual report. Wait, see, this is an annual report. Now there will be some messages like this. There will be some this is an annual report of a company called Hindustan Foods Limited. So now in this annual report, every financial every company will make this annual report, and this annual report you have, it's a 134-page document. As you can see it, it's a 134-page document. So in this document you will have different places. Like for example, one place for financial statements will be there. There will be some place for board's report or board's comments. We call it as management commentary. So that management commentary or board's report will be there. So in that you record it. In that you record, if you think you have to record or you have to disclose something relating to the company's contingent assets. You can mention it. You can mention it in the board's report. So all this, in any of this part, you can write about the contingent assets. But contingent liabilities, you can't record it over here. I mean, you have to compulsorily record it as a footnote to the balance sheet. I'm not sure if there was a contingent liability over here, but I'm sure. So this is all the part of that balance sheet of that company, Hindustan Foods Limited. Very good company. I'm sure you've not heard about this company at all. The ones who are not in the stock market might not have heard of this company at all, because this is not a company which is into manufacturing goods for themselves. They manufacture goods for others. They are into manufacturing for other companies. You have heard about this puff corn, right? Kurkure puff corn. So that's made by this company actually. It's PepsiCo's brand. PepsiCo owns it, but the manufacturing for the Indian market happens in the factories of this particular company. So it's outsourced. It's outsourced. We call this as contract manufacturing. So this company is into contract manufacturing. Anyway, so I was telling you about the financial statements. So the contingent assets must be written in the board of directors, may be written in the board of directors report, but contingent liabilities must be disclosed. Contingent liabilities must be disclosed as a footnote. Next one, accounting policies. What do you mean by accounting policy, sir? Accounting policy are methods. In accounting, we have different places where we have to use methods. Different alternatives are available. Now, this is known as accounting policy. Now, as I already have told you, once you choose an accounting policy, can we change that accounting policy year on year? Can we change every year? The answer is no. We cannot change an accounting policy every year. We have to stick to that accounting policy. Now, what are the places where we might use this accounting policy? Again, this question is important. Okay, this also the next one also, that is changing the accounting policy. Not next one, 15th one. 13 and 15 important for exams. So now methods of depreciation, depletion, amortization, valuation of inventories, treatment of goodwill, valuation of investments, and valuation of fixed assets, because depreciation is involved, so valuation of fixed assets also. So different methods are used. Different methods are used in these valuations. That is, accounting policies are used. Now, can you change an accounting policy as and when you need it? The answer is no. Question 16. Okay, question 15, 16, and question 13. Please pay attention. Can you change an accounting policy generally? The answer is no. But can you change it in specific circumstances? The answer is yes. What are the circumstances? We have three things. L, A, B. Right? L, A, B. What does L stand for? If it's required by law or statute, we call it a statute also. So if it is required by a statute, law means statute, statutory requirement. For example, Companies Act is a statute. A, accounting standard. B, better presentation of accounts. So if that particular change results in better presentation of accounts, then you can give the you can change the accounting policy as well. So that is question 16. What are the different types of valuation principles? Historical cost, current cost, realizable value, present value. Now, what do you mean by historical cost? Historical cost is the cost incurred to purchase an asset, to acquire an asset, that is known as historical cost. What do you mean by current cost? To buy that similar asset, how much you have to pay to. What is realizable value? The sale value of the current asset is known as sale realizable value. What is present value? The future cash flow that an asset will generate, discounted to the current values, are known as present value. The discounted value of future cash inflows. You can just read it once from your notes, but not so important for the exams. Next, advantages of accounting standards about convergence, IFRS. Just have a look once. Not so important, I guess, for the exams, but just have a look once. Okay, now I will look at the capital and revenue, expenditure, and receipts. I flew through that last part because it's not so important for the exams. And even if I sit and explain all that properly, at the end of the day, you have to study it for 4 marks and go to the exams. As I mentioned, here I'm going to keep it as exam oriented as possible. Okay, we're going to discuss those things which we need genuine help in. We need help, we need support from my end. There I'm going to come in. I'm not going to focus on things which you can, which you should, and which you have to study on your own. That is the 4-mark theory question. You have to study on your own. Okay. Shall we start with the capital expenditure and revenue expenditure? Yes. Now, what is this capital expenditure and revenue expenditure, and how does it impact? Why do we talk about this in accounting? So quickly, yes. Okay. So let us take this example. Let us take about this example which you might have heard before, but again, let us say we incur an expense. We are starting a business. Okay, we are starting a new business. Let us say we are starting what is furniture business. We are into making furniture. So when we are making furniture, I will need some. Please pay attention to this example properly, because this will help you understand capital expenditure and revenue expenditure properly. So I'm going to start a furniture business. Now, to start a furniture business, I will have to spend some money. I will have to invest some money into the business. Now, this expenditure, I go to a market to buy some things. There are two shops in the market. Shop number one, I'm going to buy some equipment, some tools. Like, for example, the furniture cutting machine, the wood cutting machine, the paint brush required to finish off the machine, the furniture at the end. I have to paint it, right? I have to oil paint it. For that, I need that paint brush. Then from the second store, I buy the most important thing, that is you need wood, you need timber. So I buy it from the second shop. These are the purchases I have for my business. Now I have a question. You have paid this, but are both in the both of this as an expense? We treat this as an asset, what we call as an asset, and we treat this as an expense. Okay, so this is known as capital expenditure. What we buy, the tools, equipments, and all is known as capital expenditure, and the timber, the wood we purchase is known as revenue expenditure. Now, why? How did we make this differentiation? What did we consider to make this differentiation? Some important pointers were discussed. Some important points we have to look at. Okay, first one, factors to be considered in determining the time and the nature of the expenditure. The nature of the expenditure, how do we determine this? It will depend on certain factors. Number one, the nature of the business. What business are you into? That is very important. Now, I was a dealer of furniture, or rather, let us say, I give this, let us think of furniture, or let us look at building, or let us look at machines. Is it always an asset? The answer is no. If you are into dealing of those machines, or that building, or that furniture, for you it is an expense. For example, Harsha Furniture, for a shop which is dealing in furniture, what is purchase of furniture? Is it an asset or expense? It is an expense. They book it as a revenue expenditure. So the nature of business is also very important to consider. Then the recurring nature. How often does it recur? The recurring nature of the expense also is to be considered. If it is recurring in nature, is it capital or revenue expenditure? An expenditure is recurring in nature. Is it capital or revenue in nature? It is revenue. Very good. Next point, materiality, the significance of the amount involved. If the amount involved is very small, uncertain, it's not so material, it's immaterial, it's insignificant, not so important, then we treat it as revenue expenditure. Don't record it as an asset. For example, stationary items is always stationary item could be non-recurring in nature, right? When you're talking about a pen, when you're talking about a highlighter like this. Now these highlighter or pen, pencil or whatever you're talking about, this could be non-recurring in nature. Does it mean it is an asset for the business? No, sir. It is not the only thing you have to look at. You have to also consider the next factor, which is materiality. Because the amount involved is small. I bought this for 20 rupees. I bought this highlighter for 20 rupees, which is small. You don't have to show small amounts as assets. We show it as expenses. So materiality is also an important factor to be considered. And then you have effect on revenue generating capacity of the business. I'll make this easy for you. This is the theory part. I'll make this as easy as possible for you, especially for the 2 mark question. My concern is that 2 mark question for your exams. So let us understand this in 2 pointers, or I'll make 2 branches. Okay, so please pay attention, guys. Number one, at the point of purchase, whatever expenses we are incurring at the point of purchase, it is always treated as what? Always treated as capital expenditure. When I say capital expenditure, we show all the capital expenditures in the balance sheet. We show all the capital expenditure and capital receipts in the balance sheet. So at the point of purchase, whatever expenses we incurred, we treat it as capital expenditure. Sir, why, sir? Can someone tell me why do we do this? Why do we show everything as capital expenditure? Which concept? Because of the cost concept. Because of the cost concept, we show all the expenses incurred at the point of purchase as cost, as the part of the asset. At the point of purchase, whatever expenses you have incurred is treated as an asset. Sir, what about second-hand assets? What about second-hand assets? Second-hand asset also, everything at the point of purchase of that asset, whatever we are incurring, it is to be treated as uh, capital expenditure. In the case of second-hand asset, we call such expenditure as overhauling expenses. What do we call it as? Overhauling expenses. So these overhauling expenses must be treated at the point of purchase. Whatever expenditure we have incurred relating to that asset must be capitalized, must be shown as capital expenditure. Remember this. After that, during the life of the asset, you have to look at 2 things. Okay, this is how your mind should work when you look at a question relating to capital expenditure or revenue expenditure. First question you have to ask, point purchase. If it is point purchase answered, capital expenditure, always capital expenditure. What if it is during the life of the asset? If it is during the life of the asset, then is it increasing your revenue generating capacity of the business? That is, we should ask ourselves a question. This question we will ask, and then we will draw that arrow mark. Is there an increase in revenue generating capacity of the business? If your answer is yes, then what is it? If your answer is yes, what is it? It is capital expenditure. If your answer is no, then that is a revenue expenditure. Now, this is it. You have to remember this chart. That's all. To understand revenue expenditure and capital expenditure, just this chart is sufficient. Okay, just understand this chart. Now, here, one thing keep in mind when we look at this chart, at the point of purchase, when I say, if we are constructing an asset, we are constructing a building, whatever expenses incurred to construct that building, it could be building small huts, small temporary sheltered places, it could be anything relating to construction of that building, capital expenditure. For example, you are building a house. To build that house, first what you will do is, what you might do is, there might be an old structure over there, one old house might be there, your old house only might be there. You will destroy that house completely first. Now, to destroy that house, you incur some expenditure, some JCB you called, some expenditure like this you incurred. Can you tell me what is the nature of that expenditure? Capital. Because why? It's for construction of a new asset. No, you're constructing a new asset. So that is why that cost is also capital expenditure. Then you put some sand, you put some mud. Let's say you put some mud. You raised the land. It was too low. It was too low. So what you did was you put some loads of mud. What is that? Capital expenditure. Then not just that, you wanted to take some legal advice relating to the ownership of land and relating to the structure that you are constructing, because municipality has some rules and regulations relating to construction of house, that you should have this much square feet. We call this a floor space index in technical terms, but some rules relating to this the government has, the municipality has. So you go to a lawyer and you take his advice relating to this construction of the house. You take some advice. He charges you. What is this? Again, capital expenditure. This is also capital expenditure. It is linked to the house. It is linked to the house. So this is all construction of that building. Then you get some raw materials. You get some sand, or you get some cement, some bricks and all that. You don't want to keep it out. You don't want to keep it outside. So what you do, you build a temporary structure, turple and all you put, and you build one temporary structure, which is going to be destroyed later on. This is not permanent. This is not permanent. Okay. This is going to be destroyed at the end of the construction. You will destroy this. What is that expenditure incurred for that? Again, capital expenditure. Again, capital expenditure, because it is linked to construction. No, you might destroy it later on, but did you just construct it just for this? No, it is again capital expenditure. Then what are the expenditure you could incur relating to maybe the labor has to stay, the labor for construction, they have to stay. For them, you build some temporary house, temporary huts. For example, you see these big apartments and all they construct. So relating to the they will build some smaller huts for the labor to stay, the construction workers to stay. What about that cost? Capital expenditure. That is also capital expenditure. Sir, you might you might spend some money on their food, on their some expenditure you might spend. Again, capital expenditure. All that is capital expenditure. It is relating to that building, no, construction of that building. Whatever expenditure is relating to that building to make that building ready, whatever expenditure you incur, that is capital expenditure. I hope you're following this. So if you keep this in mind, you can answer this question. 2 marks is in your pocket very easily. Okay, 2 marks is in your pockets very easily. Sir, what about later on? Later on, during the life of the asset. During the life of the asset, you have to ask this question I told you. Is there an increase in revenue generating capacity of the business? Now, for example, after constructing the asset, it's ready. Now, you use it for few months. There is some leakage in the house or in the in your building. Let's say it's a commercial complex. You are using it as your shop. There is some leakage. You repair it. Can you tell me what is this expenditure? Is it increasing your revenue generating capacity? Is it increasing your revenue generating capacity? No. So what is it then? It is a revenue expenditure. If it is not increasing your revenue generating capacity of the business, that is a revenue expenditure. You paint the building. You paint the building after 2 years. You're painting the building. What is it? Revenue expenditure. It is revenue expenditure. You whitewash the building. You put some, some coating and all. You do everything is a revenue expenditure because it is not increasing the revenue generating capacity of the business. I hope you're following this. So the important point is you have to keep in mind is it increasing the revenue generating capacity of the business? You add an additional space. You build a smaller building near you, near the existing building. What about that? Is it revenue or is it capital? It is capital expenditure. Wonderful. It is capital expenditure. So if it is adding an additional asset, you're constructing a new asset, you're adding one floor or you're adding one terrace, you're putting one, for the terrace, you're putting some roof and you're converting it into a room, additional room. It is addition. It is a capital expenditure. We call that as capital expenditure. So these are the important points you have to keep in mind. If you understand this much, more than enough. One more point will be relating to, let's say there's a case against you relating to that building. Someone has put a case against you saying that you are not the actual owner of the land. You have got it illegally. What about this? There is a case against you. Lawyer's fees. What about the lawyer's fees that you pay over here? Is it capital expenditure or revenue expenditure? Is it adding? Is it adding anything? Is it adding more revenue generating capacity to your business just because you're paying the fees? No, you're just maintaining that asset. It's just maintenance of that asset. Again, it is not a capital expenditure. It is a revenue expenditure. We call this expenditure as revenue expenditure. Now we will solve some questions relating to this and then we will get back to our discussion. Shall we? Okay. Classify the following into capital expenditure and revenue expenditure and receipts. I'll talk about this later on, but first we'll solve this question. Overhaul expenses of second-hand machinery purchased. What is this? At the point of purchase, you will renovate it. For example, you bought a second-hand building. You bought an existing building. So for this, you are renovating it. You don't like the vastu of that building or you don't like something about that building. So you renovate it at the point of purchase. It is a capital expenditure. What is that? Capital expenditure. Installation cost of a newly purchased machinery. Again, capital expenditure. Because at the point of purchase, whatever expenses we incur is capital expenditure. Legal fees to acquire property. Lawyer fees you're paying to acquire a property. What is this? Again, capital expenditure. Come on, guys, as much as possible, participate in the discussion. Come on to the chat box and put the answer. You can put CERE like that. Use the shortcuts. Amount paid to management company for consultancy to reduce the working expenses. Okay, that's very interesting. Very, very, very interesting. Okay, what are they saying? Amount paid to management company for consultancy to reduce the working expenses. What does this mean? I will give you a simpler example to understand this. You have a motorbike. Okay, let us say Domino's, the pizza place, has a lot of bikes with them, motorbikes they have. Now they add a filter to this bike. Okay, you know, right? They add filters, you have various bike filters and all. So they add a filter to this bike. Now, because they added this filter, it's going to increase the mileage of the bike. It's going to increase the mileage of the bike. What is this doing? What is this doing? This is going to reduce our expenses in the future. Yes or no? Is it going to reduce my expenses in the future? Yes. When you're reducing expenses in the future, is it going to increase your profits? Is it going to increase your profits for the future? The answer is yes. So that means directly it's not adding income. Directly it's not adding income. Just because you added a filter, you will not get more orders. More pizza orders you will not get. That's not what it means. But it will indirectly increase your net profits. It will increase your profits of the business. Just because you have filters, someone will not say, oh, Domino's, they have a bike, they have filters in that bike, let's buy from Domino's. No, no one's going to buy from you for that sake. But this is going to increase. This is going to increase your profits every year because your working expenses, that is your future expenses, have been reduced because of this expenditure. So what does this, sir? Where does this fall? Is there an increase in revenue generating capacity of the business? The answer is yes, sir. It is going to get me more profits in the future. So that means what is it? It is capital expenditure. I hope you've understood this. This is the most important. Most of you get confused with points like this. So I'm discussing this in detail. So that means this is capital expenditure. Now, sir, Domino's added a filter which did not change the mileage. What it did was it started making new noises. It started making new noises. It said, Pizza Hut boo boo, Pizza Hut boo boo. Now, what is this expenditure? Every time you started writing, it would say Pizza Hut boo boo. What is this expenditure? This is revenue expenditure. This is revenue expenditure. Wonderful. It is revenue expenditure, and because it's not adding any revenue to the business directly, so we call it as revenue expenditure. Coming back to this fourth point. What is this fourth point now? Amount paid to management company for consultancy to reduce the working expenses. This is, you're reducing your working expenses. That means it is a capital expenditure because it is going to generate more profits in the future. You're going to add for profits. You're going to get more profits. Lesser expenses means more profit. So that is why it is capital expenditure. Amount spent as lawyers' fees to defend a suit claiming that the firm's factory site belongs to the plaintiff. Plaintiff means complainant, the one who's complaining. So, to the plaintiff's land. What do you say about this? What do you think about this? Is it at the point of purchase of an asset? First question. Is it at the point of purchase of an asset? No. Second one. Is it generating more revenue to the business? Directly or indirectly? The answer is no. So what should be my end answer then? It is a revenue expenditure. So that is why it is a revenue expenditure. Amount spent for replacement of worn out part of the machinery. First question. Is it at the point of purchase of the asset? No. Second one. Then it is during the life of the asset. Is it increasing revenue generating capacity of the business? Is it increasing revenue generating capacity of the business? What do you think? For example, I have the AC remote, okay? This is the AC remote. The battery has become older. Okay, the battery has become older. It's worn out. I'll replace the battery cell. Now, because I changed the battery cell, will I get a new AC? Or will the AC start working differently because I've changed the battery? No. Will it go beyond lesser than 16? And now the minimum is 16. Will it go lesser than 16 just because I've changed the battery? No. So, what do you think it is? What is the battery expense there? Is it capital or revenue expenditure? Replacement of battery. It is revenue expenditure. No. It's just for maintenance. It is revenue expenditure. Well, how are you saying it's capital? No way it can be capital. It is revenue expenditure because it is not generating any additional revenue. It is not generating any additional revenue to the business. It is not adding to the revenue generating capacity of the business. We are just maintaining the revenue generating capacity of the business. We are just maintaining at that level. For example, I told you, let us say, in the case of a machinery, one of the parts of the machine is spoiled or lost, or something happens, not lost, something happens to that part. It fails, it breaks down. So I have to change a part of that asset. Just because you're changing, that doesn't mean the asset will become more efficient. It will get back to where it was before. It's not going to increase its revenue generating capacity. So it is revenue expenditure. It is revenue expenditure. Wonderful. Expense incurred on the repairs and whitewashing for the first time on purchase of an old building. Is it at the point of purchase? Is it at the point of purchase? Yes. Close your eyes and say it is capital expenditure. If it's relating to the asset at the point of purchase, it is capital expenditure. Expense in connection with obtaining a license for running the cinema. Is it at the point of starting the business or starting the cinema? The answer is yes. That means what is it? Capital expenditure. For example, you have to start a cinema theater. We're talking about theater over here. You need a license to run cinema. No, anyone can't start. For example, if you want to start a bar and restaurant, you need something called as a liquor license to sell alcohol in a restaurant. You need a liquor license. State government issues this. So when you're starting that business, you have to get that license. It is a capital expenditure. It is a capital expenditure. It is at the point of starting that business. It is an asset for you. So that is why it is a capital expenditure. Okay, this we have already discussed. This was an exam question. Okay, this had come in one of the attempts. Amount spent for the construction of machinery, temporary huts, sorry, or for construction of temporary huts, which were necessary for construction of the cinema house and were demolished when the cinema house was ready. What do you think this is? Again, this is capital expenditure, sir, because this was for construction of the cinema theater, cinema hall. Whatever is relating to the cinema hall construction, we will call it as capital expenditure. Amount spent on demolition of building to construct a bigger building on the same site. This also I discussed with you when I gave that example. You had an old building, we are destroying that old building and we are building a newer building on that. So this is 10th one, I'll come back to it. I'm discussing 11th one now. It is capital expenditure. 10th one is a receipt. I'm sorry, I skipped it. I'll come back to it very soon. Okay, 13th one. I'm going to discuss the 13th one now. Amount spent on additional rooms to an existing building. What do you think this is? Amount spent on additional rooms to an existing building. Additional rooms, that means you're creating newer assets. It is capital expenditure. Wonderful. It is capital expenditure. Amount spent on motor car to get better fuel efficiency. Capital expenditure. I gave you that example of filters. You add filters to your bike, car, which will increase the efficiency of the car or the vehicle. So when that happens, what happens? Your future profits are increased, right? There is an effect on your future profits. There is an increase in future profits. So that is why we call it as capital expenditure. So if there's an increase in the future profits, that is capital expenditure. I hope you've understood this much. I hope you followed it. This is with relation to capital expenditure and revenue expenditure. So please take this chart down in your notebook. This is, if you know this chart, if you know this much, it's more than sufficient. You will be able to answer any kind of question asked from this particular chapter. 2 marks question will come. So this is in your pocket. I'm putting it in your pocket. So please take it seriously. Okay, now coming about receipts. Receipts, we have to look at one point, okay? Receipts, you have to look at only one point. What is that point? That is, if it is recurring in nature or non-recurring in nature. If something is recurring in nature, continuously you're getting it throughout the year, or it repeats in it keeps repeating, then in such cases we call it as what? What do we call it as? Revenue receipt. If it is non-recurring in nature, then it is capital receipt. Then it is capital receipt. Okay. So that is the point you have to remember with regards to 11th and 12th one, which we did not do. Amounts received from trade receipts during the year. What is this? Capital receipt or revenue receipt? It is revenue receipt. What about insurance claim received on account of a machinery damaged by fire? One time, right? It is not something that you keep receiving. It is a capital receipt. Insurance claim means you've lost an asset because it is damaged. So because of that damage, you're claiming some insurance money. Now this is capital receipt. So just to close this over here, just remember revenue receipt are those receipts which we keep repeating throughout the it is recurring in nature, and in the case of capital receipt, it is non-recurring in nature. So that one point you have to keep it in mind. Yes, it is at the current level itself. Production at the current level itself, Lakshmi. It does not increase, it does not decrease also. It does not decrease, it does not increase also. So it is maintenance at the current production level. The sixth point she's asking, so it does not decrease, right? But it does not increase either. So there must be an increase in the revenue generating capacity. It's not doing that. So that's why we call it as a revenue expenditure. So what about insurance premium paid? For machineries, we pay insurance premium. What is the nature? Revenue expenditure. It is revenue expenditure. You have to pay it annually, yearly. You have to pay. It's not creating. It's not directly creating an asset. That is why we call it as revenue expenditure. Okay, so that is about capital expenditure and revenue expenditure. I hope you have followed this. This is about the capital and revenue expenditure. Just to consolidate and give you some tips, I flew through this chapter because it's not something that I have to explain too much in the class. But remember, in this chapter when you're studying, uh, I'll just give you the overview here. So we have discussed about meaning and scope of accounting. What is accounting? The different financial statements. Who are the users of financial statements? Limitations of accounting. Objectives of accounting. Objectives of financial statements. All that is discussed over here. Accounting principles, concepts, and conventions. A couple of questions are added over there, which is you have 9 concepts actually and 4 conventions. Capital revenue and revenue expenditure and receipts. We have discussed this. Here, one more point is deferred revenue items or deferred revenue expenditure as we call it. What do you mean by this? These are revenue expenditures, okay? Deferred revenue expenditures are revenue expenditures, but they are huge in nature, and generally the benefit is for a long time. It's not just for 1 year or so, it's for a longer time. So we call it as deferred revenue expenditure. We treat it as an asset. The examples could be a preliminary expenditure you incur when you start a business. Okay, when you start a business, generally we consider it as preliminary expenditure, deferred revenue expenditure, or huge cost in advertisement. Huge advertisement expenditure, these big billboards or sponsorships of big things. So, for example, I give you that IPL example, Vivo IPL. So all these are big advertisement expenditure. So that is to be considered as deferred revenue expenditure. What we do is we treat it as an asset. We treat it as an asset, and we book it every year, part by part in the profit and loss account. So this is about big advertisement expenditure, that is generally sponsorship and all that. Just remember in the exams, if they ask you a big, huge advertisement expenditure incurred or something like this, they will give that is deferred revenue expenditure. Don't expect a question on this, but just keep that in mind. Okay, contingent asset and contingent liability. In this, I want you to focus on three things. One is difference between liabilities and provisions. Liability and contingent liability. Provisions and contingent liability difference, disclosure of contingent liabilities and contingent assets. Three very important questions for the exams. So the third question I expected to come for, there's a high chance that it might come. That is disclosure requirements of contingent assets and contingent liabilities. Accounting policies, here focus on the change in accounting policies, three circumstances, LAD. Again, this question will appear very soon. If not for your attempt, within next 3-4 attempts, it will come. So that is if it is required by law, if it is required by an accounting standard, if it results in better presentation of financial statements, it is important, it will come. I'm not sure if it will come to your attempt, but it is one of the important questions. I see it. Measurement discipline, you can ignore this, but one question I have added, that is different types of cost. Just go through it once. Accounting standard and Ind AS, just the benefits of accounting standards, and Ind AS, the benefits of Ind AS. So you can just have a look there. So that's it. That's about it from the first chapter. These are the different things covered. My request or my suggestion how to get through this chapter is, it's an important chapter. Okay, don't think that just because I've flown through this chapter, don't think it's less important. It is important. It will come for 6 marks for your exams. Definitely it is going to come for 6 marks for your exams. 4+2, that 2 compulsory question. So that 4-mark theory question is compulsory question. It is going to come for your exams. You have to study, you have to read the questions, all the questions that is mentioned in your handout. 19 questions are there, plus one capital expenditure, revenue expenditure, list of examples. Cover that properly. Study each and every question in that 19 questions also. Studied each and every question over there properly. Beyond that, I can tell you, you don't have to study anything else. So you study it properly. That's more than sufficient for the exams. 6 marks is in your pocket from this particular chapter. But be a little smart when it comes to that making the differentiation between capital and revenue items. This is something application type. It is not exactly conceptual. You have to apply over there. So I gave you that chart also so that you can apply that chart and you can think as per that chart only. Just apply that chart and think. So it's application type. Apart from that, a direct question will be asked from this particular chapter. Okay. So this is about chapter 1. In the afternoon, I'll go to the next chapter in the afternoon, which is accounting process. All right. So we'll take a break for lunch now, and after that, I will meet you in the afternoon. If you have any questions, you can ask it now. Yes, reasons, it is true or false question. So reasons will be there. You have to give a reason relating to that, Shailesh. Repairs is a revenue expenditure, Chandan, that is not added to the, Rohit, that is not added to the cost of the asset. Prithvi, you can just stick to these 19 questions, more than enough. It is a revenue expenditure, Nikhil. At the point of acquiring an asset, Chandana, whatever expenditure we incur, it is capital expenditure. It is cost relating to that asset. No, Namit, stick to the answers given in your handout. Yes, Mayur, that is sufficient. No, Shishir, I can tell you that with some certainty. It's part of the asset's cost, Chandana. The cost of the asset will be increased to that extent. Electric wires you're replacing, it is a revenue expenditure, Sushmita. I have sent the material already, Zubair. Please check with your coordinators. And then just read the questions from the material given to you. Rupa, no, it is not. The list of examples given for capital expenditure is not enough. As I mentioned, application type of question will be asked. So you have to look at the chart and you have to answer that question. Yes, reasons can be in your own words, no problem. No, Namit, not exactly. It could be a little different also. Money paid to MTNL for installing telephone. If it is refundable deposit, generally it is a deposit. It is neither an capital expenditure or capital receipt or revenue expenditure. It's not an expenditure or receipt. In fact, there are a couple of questions given in the handout. You can just read it. Shrikant, yes, footnote is required unless it is very vague. Very remote. No, these are certain assets. Debtors are certain assets. The debt, whatever bad debt you're talking about, the provision, that is an anticipated loss. Anusha, that is discussed in sole proprietor. At the point of purchase, Chandana, it is capital expenditure if you're painting the building at the point of purchase. After that, if you're painting it, it is revenue expenditure. It is generally advertisement only, Suraj, right? Only for big advertisement expenditure they will give. You write it as deferred revenue expenditure. Capital item, Prithvi, it's a capital receipt at the point of one time it is security premium. Yes, Nikita, for this particular chapter, the material is more than enough. No, it doesn't. It just fixes, it just maintains, Shreyas, the revenue generating capacity of the business at the same levels. Preliminary pre-incorporation expenditure, or in the case of discount on issue of debentures, that is also a deferred revenue expenditure. Discount on issue of preference shares or equity shares, which is not allowed, but that is deferred revenue expenditure. Or you have, this advertisement cost, as I mentioned, it is all deferred revenue expenditure. Yes, thank you. See you in the afternoon.
Dear students, the same login ID and password will be used for afternoon session. The afternoon session will commence at 2 p.m. Thank you, sir.